Hi traders, welcome back. So we'll do a summary of chapter 1, 2 and 3 of the book Secret of a Pivot Boost in this session. So let's start with the chapter 1 straight away. We have gone through these three chapters in details, but since we had a gap, so we are doing a recap of this. It's like a summary for the chapter 1, 2 and 3. So the first chapter is about understanding the market, about the basics of market. Here, Mr. Frank, the author, is saying about the basics, like who all are the buyers, what types of buyers are there, which types of market days are there. So let's go. I just prepared a summary of the first three chapters. We'll just go through it very quick, and then we will move to the fourth chapter. Nowhere does history indulge in repetition so often or so uniformly as in share market. Most of the historical chart patterns repeat as it is based on human emotions. So it helps if we can find which type of day or structure in being portrayed in charts prior to engaging our trade setups. So it is said that in share market most of the things repeat, so it is good that we learn what happened before, then we will do the new trading sessions. So we will know the history first, and then so here it's about the history. What is the auction process? The auction process is the role of marketplace is to facilitate trade between buyers and sellers. So the price will auction higher and lower as it attempts to find an area where the trade can be easily facilitated. If there is more buyers, the price will go up obviously. If there is more sellers, the price will go down. If the price opens too low, it will auction higher to find sellers. And if the price is too high, it will auction lower to find the buyers. So that is the auction process. A buyer will be buying a share or a portion of the company, or if it is in options, uh, it's a different thing. But if it is in normal share market, it is about buying a share of a company. A seller will be selling it, and buyer will be buying. That process is called the auction process. So which all types of buyers and sellers are there? Let's go in detail about that. Your ability to determine which market participants are influencing price allow you to judge the conviction and behavior of price movement. There are mainly two types of buyers and sellers. One is a responsive buyer and initiative buyer. So what is the difference between a responsive buyer and an initiative buyer? A buyer that enters the market when price is below value is called a responsive buyer. A buyer who feels that the market is undervalued. He thinks that this share, whichever company he is focused, or the share which he or she wanted to buy, is at a cheap price. He thinks that the valuation is correct. That is, he's responsive. He's responding to the situation, and he is just going to get the enter the market to take it to a fair value. So if the price is below the fair value, so he is going to buy it and make it. Since he is going to buy, the share value will obviously increase. He or she is buying means the share value will increase and it will go to a fair price. That is called the responsive buyer. If the same is done by a seller, it's a responsive selling. That means he's responsible to keep the market in a fair buy and sell area on an average a good price instead of taking it very high, uh, like that. That is the responsive buyer and seller. So, and the second type is initiative buyer or seller. An initiative buyer enters the market when the price is at or above value. This type of buyer is taking the initiative to buy price to a higher value of area. So initiative buyer is not unless like a responsive buyer, he's not buying it for a cheap price, he's buying it for a higher price, thinking that this value, the share will go even higher. It is based on his conviction that he is buying such kind of share. So it's basically that he is believing, for example, if in case of Apple share, we can see that it's already trading at a very high price now. Not now, it was trading at a very high price, but still people were buying it because of thinking, because of the value it is having, because of the company status and everything. There is a conviction that it will go above, so that is initiative buying. But now the prices came down, so now the responsive buyers will get in. That is the difference. So the responsive buying and selling will typically drive price back to the responsive buying and selling is to make sure that when the price is very high, they will sell and make it to an average price. When it is very low, they will buy and make it to an average price. So it is typically to drive price back towards the mean, sending price towards an area that is considered fair value by the market. Therefore, price movement is in short term oriented and lacks true conviction. So that is the responsive buying and selling. It's taking back to the mean. There are and as per the author, now let's go to the market type. So there is four types of buyers and sellers. Now let's go to the market days. There are six types of days. The author has divided the market days into six types, considering the historical events about how the price moved from one price to another price. So that price, uh, 6 days are trending day, double distribution trend day, typical day, expanded typical day, trading range day, and sideways day. So let's check. I have took some charts as a reference. So in the trending day, price will open. The initiative buyers and sellers with conviction will take the price from a portion from the opening to the close. It will be one-sided movement, and the price will move like anything. It is like a sprinter. It is running from one area to the other. In a double distribution day, the initial balance is the high and low of the 1 hour. Considering this as 1 hour, it's 5 minutes, so that means there will be 60 minutes candles here. So the first hour's high and low is marked, and when this range is broken, the price will be moving inside this, it will be having a distribution inside this. Then the initiative, here the responsive buyers and sellers are there. Then the initiatives buyers, here the initiative sellers got in. They think that the price can move below. They started selling from here, and the price suddenly started moving very low. And after a huge fall, then the second phase of distribution started. Then the high, it's just started moving around in this range. So it's just started with it. The end of the market day was with the second distribution. That's why it's called a double distribution. There is two distribution. This is the first distribution, this is the second distribution. And now the third type is the typical day. The typical day is like the initial balance. This is the first 1 hour. It's 5 minutes. So the first 1 hour high. This is the high of the first 1 hour and the low of the first 1 hour. So the this high and low, this gap is called initial balance. So the price is happy to settle in this area. If this balance is very wide, then the initiative buyers will not attend the market, because it is already very wide and it is very hard to take it outside this range. So in such days is called typical days. There won't be much movement outside the initial balance. The whatever buyers and sellers have participated mostly in the initial hour itself, and the price is auctioning in between these price range. And the fourth one is extended typical day. Extended typical day is the initial balance is not that wide, but the price kept on moving inside the initial balance, and by the end of the day, initiative sellers took the price to a lower price range. So the in an extended typical day, the typical day range is broken. The initial balance is not that wide, and due to that, after a distribution, there is a breakdown. So that is extended typical day. That is the fourth type. And the last two types are the trading range day and sideways day. These are similar things. The range day is obviously, as the name says, it's a very wide range, and price moves from one area to the opposite area, like the tennis match it is happening. The Here, when the price reaches the initial balance high, here the responsive sellers, they will take it back to the average area. Around this area, they will take it below this area. From here, the responsive buyers will start buying and take it back to this area. Then here again, the responsive sellers will think. So this will be trading inside a range. That is the trading range. And sideways days is when there is any specific holidays or something. There will be very less participants. There won't be much sellers and buyers. So the movement will be sideways. There won't be much price deviation, and the volume will be very less. So these are the reasons responsive buyers actively push the price in opposite directions. In expanded typical day, both upper and lower circuit of the initial balance are susceptible to violations. So that is the first chapter. It is basically about types of buyers and types of market days. It is very helpful to know these things, because once we understood that the day is trending, then we can enter the market with conviction and do the trading. For example, in Nifty, if we check, this is a pure trending day. See here, here the market opened and then it kept on going higher high and higher high. It was a trending day, pure trending day. Let's see if we can find it. So these kind of things will help to identify the market structure if it is going higher and high. So once we realize which type of day, if it is a sideways day, we can stay out of the market, like that. So let's get into the second chapter, which is engaging setup. So we know the types of market, it is the history is done. Now we need a setup to enter. We know that it is a trending day, or it's a typical type of day. We have understood these things. Now we need a setup. We can't directly enter and buy and sell things, so we need a setup. I may plunge or I may buy 100 shares, but in either case I must have a reason for what I do. So I need a reason to buy this thing. Like I bought this share because it was trading at this low price, or this was having a candlestick pattern of this sort. So that is the thing author is saying, that we must have a reason to buy or sell that share. There must be a specific set of rules to take the trade instead of randomly buying and selling to become consistent in making profit from trading. We can be profitable if we are randomly buying and selling, but To have a consistent profit, we need a set of rules. We need a specific set of rules. So I'll be buying only when this kind of setup comes. So let's go. The author is giving 4 setups in this chapter. Let's go in details about this chapter setups. So the first one is wick reversal setup. It is nothing. So you know what is wick. The candlestick consists. So the candlestick consists of a body. This is the body. This is the wick. Whatever price it moved, maximum and top. This is where it opened. This is where it closed. Maximum price it went to, and minimum price it went to in a specific. If it is 5 minutes, in 5 minutes, till which level, till which price it went, that is the maximum. This is till which price it went down, that is the minimum price, that will be wick, and the opening and closing will be the body. So what is wick reversal setup? In wick reversal setup, it is basically about a doji candle, doji kind of candle. So this candlestick is, there is 2 specific conditions mentioned by the author. It is that the body is used to determine the size of the reversal wick. A wick that is between 2.5 to 3.5 times larger than the size of the body is ideal. Wick should be 2.5 to 3.5 larger. So for example, this is the wick. If the body is only this much, this is, if this is x, then this should be at least 2x or 3x. It's more than 3x, I guess. 3x. It's preferred to have a 3x wick, 3x or 3.5 times. This is the requirement of first requirement. And for bullish reversal, the close of the bar should fall within the top. So if it's a reversal setup, since this is the 100%, this close, this body closing should be, this is the opening, this is the closing. So this closing should be in the top or bottom 35%. If this is the candle, this is the 50% of this candle, and it is falling inside the 35% range. So this candle is considered as a wick reversal candle. Now where to use it? This can be used in areas when there is an uptrend and suddenly this kind of candle happens, then we can take trade below this. Once a candle close below this, then we can directly enter the market and take the profits, keeping the stop loss here. We can enter here, or if you want, then you can enter here, considering that the candle is closed, purely closed after this, and then the stop loss will be maybe lesser. Here you can keep the stop loss and then take the target here. So we will check an example for this. So I have already I'll keep the wick reversal setup. You can just go to the indicators in trading view and search wick reversal. You will get the pivot post wick reversal setup. You can just put that and check if it is working or not. You can just do a back testing. So here you can see that These all are the wick reversal setup indications given by the indicator. Here, let's say in the top, it's not falling into 35%, I guess. It's falling into 35%. So the body, the wick is more than uh, 3 times, and the body is falling into 35%. So I will be taking a trade below this, keeping the SL will be here, and it should at least give 1:2. But here in this case it's reversing and hitting my stop loss here. Or you can do, if it is 1:1 or 1.5, give it as 1:2. It is, I can, in this case it's giving an SL if you are keeping it 1:2 risk reward. So if you are keeping a 1:1.5 risk reward, you will get the target here. Similar like this here also, it's going down and suddenly there is a reversal setup. So here you can buy above this, keeping the SL here, and here you can ride this trade and make it almost, it's giving risk reward of, you can buy it from here. It's almost giving 1:3 risk reward. So this is just, you can do the back testing. You can take it at all position. You have to just consider this wicks, these candles near the support and resistance. That details will be, we'll discuss in the next. Here, for example, you can see that this is the main area. So you can, if any reversal is happening in this position, for example, this is the main area. So if there is any reversal happening from this position, it will be very good. Like that, you can mark the support and resistance, then consider the candlestick pattern. So the next pattern is extreme reversal setup. For the extreme reversal setup, the conditions, there is 3 conditions. The first condition is, the first condition is, the first bar of the pattern is about 2 times larger than the average size. So here, considering this is the average size of the candles, all of a sudden there is 2 times big candle. This candle is very big, 2 times, minimum 2 times, more than 2 times obviously. And so this is considered. And the first bar of the pattern should encompass more than 50% of the bar. So it should be more, it should cover the more than 50% of the bar's total range. It is covering more than 50% of the bar's total range. Okay. So these 2 conditions are met. The second bar of the pattern opposes the first. Second bar, so this is a green candle, or it's a bullish candle. And then the second candle is a bearish candle. It's in the opposite direction. That is the third condition. The second candle should be in the opposite direction. The first bar of the pattern is bullish, then the second must be bearish. If the first is bearish, then the second should be bullish, like that. For example, here here the first candle is okay, we'll check in this. This is the first candle. Its average size is more than the previous candle. Here it's more than 2 times, except this, I don't think it's 2x. And the next candle, this is a bearish candle, and the next candle is this is bearish and this is bullish. It's a green candle. So above this candle we can purchase, and the stop loss will be here. Here I can getting a good risk to reward ratio. Can book it from on top of the candle here also. So that is the extreme reversal setup. You can find the same here in the extreme reversal pattern again. Here there is an extreme reversal pattern. There is an extreme reversal here. The first candle is a bullish candle. It's more than considering this 3 or 4. This considering this range. This is a very big candle. It's a green candle. Then the next candle is a red candle. So below this red candle you can do the shorting. Here you can go for a short below this candle and keep the SL here. Then you can at least on the same day, if you're booking, if you're doing it as an intraday trading, you can close it at 2:1:2 here easily. So these setups are working as of now. You can do the back testing and then take the trades accordingly. And the third setup is engulfing near breakout or fake out. It's the outside reversal setup. So the three conditions here are: the engulfing bar of a bullish outside reversal setup has a low that is lower than the prior bar's low, and a close that is above the. So it should clearly engulf the previous candle. It should it is engulfing means it is clearly covering this candle, and the engulfing bar of a bearish outside reversal has a high. It's having a high that is above the prior bar's candle. This candle's high is more than this candle, and a close that is below the prior day's close. Means the close is here, so it's more than this for obviously, so it is covered. Usually 5 to 10% larger in size of the average bar below. So it's 5 to 10. If these 4 candles are considered, it's 5 to 10, 5 to 20% bigger this engulfing bar. So the conditions are met. You can go short once there is an engulfing candle, outside reversal candle. So we will check it in this. So here we are putting the outside reverse candle. Let's see, it's good in 1 hour charts. I think I mentioned it here. It's better to use it in a higher time frame, or it is good in 15 minutes chart also. So let's try it in 15 minutes. Outside reversal is here. We can find an outside reversal. See, this candle is clearly covering the other two. So you can go here a short. No, it's not possible, but still it's giving 1:1.5. So if there is any good so here this is another outside reversal. The candle here is very big. The closing and opening is more than the old one, points, and the candle size is around 25% bigger than the previous candles. And once this is trading about this, you can buy from here. You can buy from here, keeping the SL below this distribution area or this area, and then you can get around 1:3 risk reward. So that's it. And the last setup is Doji reversal setup. So you know what is Doji? A Doji candle represents indecision in market and can expect a reversal at any time. Preferred in a 1 hour chart. This setup is preferred in 1 hour chart. For this we need an SMA, simple moving average also. So the concept is simple. The opponent close price of the Doji should fall within 10% of each other. So that means it is just opening and then just trading and then closing. So there won't be, the body will be very small. That is a doji. For a bullish doji, the high of the doji candle should be this. If this is a bullish doji, means the opening will be here, closing will be here, and high will be here, low will be here, obviously. So the high should be, if it's a bullish candle, the high should be below the 10 moving average. If there is a moving average, simple moving average, the high of this doji candle should be below this. If it is a bearish, the high should be above this. One of the, so if it we'll considering the bullish case, so in the bullish doji setup, one of the two bars following the doji must close above. So here the high is below the simple average moving 10 days simple moving average. Then the next two candles should close above this. One of the next two candles should close above the high. Then we can go by call or for an upside trade. So let's put that here. We'll close this one again. So we will search Doji reversal pattern and SMA, simple moving average, and we will make sure that this is SMA. I need SMA 10 itself. So we have an SMA here. I will check. I need only 10. So the 10. So here it is. So we need to check for a reversal. Let's consider this reversal here. It should be, the timing should be 1 hour. Okay. Here. Okay, this looks perfect. So here, this is the doji candle, okay, and the doji candle is closed. The opening and closing is below the simple moving average 10. the high. Once the high, the next candle will be breaking and closing above the high, so we can go buy above this and book profited maybe 1.5. If you're not booking the profit at 1 point or 2, then it's an SL. It will hit your SL, so it's already booked here. So that's it for today. No, we'll complete this one also, introducing the time zone. So the next chapter, so we have learned the 4 setups in the previous chapter. In the first chapter it was about the sellers and buyers and the market types. Now the second chapter is about 4 types of patterns that we can use instead of taking a random trade based on the candlesticks. And the third one is introducing the money zone. Where to take this, where to confirm. We can find a lot of candlestick confirmations, but where to find the zone where the maximum trade is happening. So that is the money zone. Money zone is about the market profile. It's about plotting a graph uh, with x-axis as time and y-axis as this is x-axis is time and y-axis is price. So this is showing x-axis is time, y-axis is price. So it's showing every 30 minutes an alphabet will be produced. The first alphabet is A. So the price in the first 30 minutes moved from this portion to this portion, and likewise the second happened from this portion to this portion for the next 30 minutes. So likewise every 30 minutes a new alphabet is introduced, and where the maximum alphabets is written, that area is called value area. This is the value area high and this is the value area low, and the center, the average maximum, the area where the maximum trade occurred is called point of control. This is the area where maximum trade happened. This is the price range where maximum trade happened. That is called point of control. So the buyers and sellers are interested to keep the price at that range. Once the price is, for example here, once the price is broken this area, the initiative buyers, the initiative sellers entered here, confirming that the average area is broken. Then there is a sudden bow. Then there is no buyers. Here the responsive buyers was taking and keeping it in the average area. Then all of a sudden the initiative buyers came. So we can confirm once we know that this area, and once the price started going below this, we can take an trade confirming the candlestick patterns, and we can book a good profit from this. So that is the use of this value areas. Then next is advanced money concept. So we will go in detail about this in the next video. So keep watching. Thank you so much.